Oh, good afternoon. We're just a little bit late. I'm trying to get set up here and make sure that we're recording, which we are. And tonight, week 7, we're going to cover chapters 19 and 20. 19 using securities markets for financing and pardon me, and investment opportunities. And then we're going to discuss chapter 20, always a favorite topic for everyone, especially students: money, financial institutions, and the Federal Reserve. And then next week we will cover 3 bonus chapters: chapter A, chapter C, and chapter D, those bonus chapters. And I'll give you more information about that a little bit later. So our learning goals for this evening: describe the role of securities markets and investment bankers. Identify the stock exchanges where securities are traded. There are several of those which we'll talk about. Compare the advantages and disadvantages of equity financing by issuing stock, and detail the difference between common stock and preferred stock, 2 types of stock. Most of us who own stock, or most people who do own stock, not just us, but people who own stock, own common stock. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds, and identify the classes and features of bonds. Explain how investing in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. Analyze the opportunities stocks offer as investments. Analyze the opportunities bonds offer as investments. And both do, they're different. One a little more stable than the other. Explain the investment opportunities in mutual funds and exchange traded funds, EFTs. And then describe how indicators like the Dow Jones Industrial Average affect the market. A very interesting lead into the chapter about Maria Bartiromo, or Bartiromo, I think is how she pronounces it, and I may even be wrong with that. A very knowledgeable person who reports on stocks and bonds for CNBC. So I encourage you to read that, because I think it's a very interesting little thing, little snippet about an individual that many of us may know by watching cable television. And she's very, very knowledgeable about what she mentions and what she reports on. And I think it's a very, very, very it's probably the best snippet that we have at the beginning each chapter. Maybe it's because I know her, of her, and I've listened to her, etc., and find her to be a very knowledgeable individual. Securities markets are there in the business to help people earn income. Now, that's the best way to say that. There are a lot of other ways to say it, but they're there to help people earn income. At the same time, they're there to help companies sell stock. So that's what they do. So notice they assist businesses in finding long-term funding. Well, they help individuals earn money by investing in stocks, and then they also help do other things, buy and sell and act as middle people. Now, I want to point out to you, in the chapter we'll spend a little bit of time later on talking about people who are what's known as day traders. I'm going to say it now, and if I may have the opportunity to say it again later, I will. Do not get into the business of becoming a day trader unless you know what you're doing. There are a lot of people who've gotten into this that believe that they have the smarts and the moxie and a few other things, not so much to outwit the market, but to make money in the market. It's a very difficult thing to do, and if you do not have the expertise, the time, and the resources, mostly meaning money, do not get involved in that. It's not something that is for the novice to get interested in. These are the different types of security markets, the primary and secondary, and we talk also about IPOs. Primary markets are there for new securities. And then the secondary market, these are the trades between investors with the proceeds of the sale going to the seller. I give you, for instance, when my mother was still living, she owned some stock, and we needed to get rid of that stock to get into money where she was in a nursing home, unfortunately, the last several years of her life, but we needed to get it into something that was more liquid than stock. And so when we sold that stock, the proceeds of the sale went to my mother's account. Now, I was doing that for her as power of attorney, but it went to her account. That's what we're talking about here. And I want to use an individual instance to make that point. And then the other thing that we hear a lot about is the IPO, initial public offering. This is the first time that a company has offered stock for sale. Now, that may sound like, what do you mean? First time they offered it for sale? It's the first time they allowed the general public to buy shares in their company, stock. And so that's what we hear. The last big one was the Alibaba, which is a internet company based in Hong Kong, I believe, or maybe it is mainland China. I'm not sure which. And people like to jump on IPOs because the thought is, well, the stock's going to go up and I'll make some more money, et cetera, then I can sell, et cetera, et cetera. That doesn't necessarily hold true, so you have to be careful and do your homework. Many of these companies have been in business for a long time before they went public. That's what an initial public offering means, and allowed the public to buy them. And normally they work with an investment banker, such as Goldman Sachs or an arm of another bank, to list the initial public offering, and then to maybe even work with a brokerage house, and then to set what they think the price for the initial public offering ought to be, so much per share. Investment bankers and institutional investors. Exactly what the slide here says. Investment bankers are in the business to help issue and the sale of new securities. And then institutional investors are large outfits, if you will, for lack of a better term, who manage lots of money. When I say lots of money, I'm talking about lots and lots of money, many cases in the billions, for pension funds, et cetera. The largest in the country that I'm aware of is CalPERS, which is the California Personal Retirement System. And CalPERS makes huge buys when they buy, and huge sales when they sell. And so they're very interested in these things. They'll often are invested with mutual funds, which we'll talk about a little bit later in this hour. And then sometimes they even invest their own funds separately from investing with mutual funds. Obviously, it is their money. But what I mean by that is they will invest their own funds, not through a mutual fund house or a company that handles mutual funds. These are the three major stock exchanges. Oh, well, these are two, and then we're going to get to the other one. Stock exchanges are a stock exchange is an organization where members buy and sell securities on behalf of these institutions we talked about, companies. I'm separating institutions from companies, thinking of institutions more of being non-for-profit, companies being for-profit, and of course for individuals. Now, the thing about this is the only way, at least on the New York Stock Exchange, that you can buy and sell stocks is to be a member, to have a seat on the exchange, and there's so much money that you have to pay to get a seat on the exchange. The over-the-counter market is where companies have their stock for sale, but their value capitalization, what their worth is not considered sufficient to be listed, pardon me, on either the New York Stock Exchange or the NASDAQ, which we're coming to next. The largest over-the-counter stock market for a long period of time was Amex, American Exchange. And I'm not sure Amex is still in business. They may be, but you can buy these stocks. Years ago, people referred to these as penny stocks, or a lot of these, not all, but a lot of these as penny stocks. And what that meant was you could invest virtually for pennies. And that if you had the chance of gaining a lot, also had the chance of losing a lot, but not as much as gaining a lot. And so people would invest in those and then sell the stock when they made a fair amount of money. The NASDAQ, by the way, if you watch one of the money programs, CNBC, or I think Fox has one now, MSNBC, or any of those type things, and you see people on the floor, that is the New York Stock Exchange. And those people are traders on the floor. They're working for somebody and doing the trades. And it is not NASDAQ. NASDAQ is a completely electronic firm. Now, New York Stock Exchange does electronic trades as well, but they still have traders on the floor. How long that's going to continue, I don't know. NASDAQ was kind of supposed to replace that, or that philosophy was for the New York Stock Exchange, but that's not happened as of yet. NASDAQ does do this electronic trading of securities. There is nobody on the floor. At NASDAQ the NASDAQ stock market is tech heavy. And what I mean by that is most of the stocks listed on NASDAQ are in the general computer industry. Now, these are the major stock exchanges in the world globally. You'll see that NYSE, New York Stock Exchange, Euronet, or Euronext, they're together. And as I remember, Euronext did buy the New York Stock Exchange out, even though New York Stock Exchange is a higher name recognition. And we find the NASDAQ, which we just talked about, the London Stock Exchange, which is also known as, well, it gives its ups and downs according to the FTSE. That's the Financial Times Index, like the New York Stock Exchange gives this in the Dow Jones, which we'll talk about a little bit later. The Tokyo Stock Exchange, and then the Deutsche German Börse. The other one that is large is the CAC 40. That's in France. The Hang Seng in Hong Kong is a large stock market. I don't remember what the name for the Tokyo Stock Exchange is. I'll have to remember that and give it to you some other time. But those are the major stock exchanges, plus the Hang Seng in Hong Kong that I mentioned to you. We talked a little bit about this last week, and I'm not going to dwell on it, and that is that the small businesses, since the financial meltdown that began in the late 2007, have had a very difficult time trying to get traditional investment. And so notice that this individual wants a new stock market that is set up specifically for small businesses. I think that's going to be very difficult. There's already an index for small businesses known as the Russell 2000. And it watches small businesses and small stock, small capital stock. If small, I may have mentioned it here in the course before. If I haven't, I'll do it now. Small is a relative term. And do you mean small in size of employees? Do you mean small in size of value capitalization? Now, what does small mean? And so I think that it's going to be difficult for someone to come up with that. The Securities and Exchange Commission is the watchdog over Wall Street. It was implemented as part of President Franklin Roosevelt's New Deal administration. His first administration came into office in March 1933. And the first chair of the Securities and Exchange Commission was Joe Kennedy. I couldn't think of his first name for a second. The father of President Kennedy and Senator Robert Kennedy and Senator Ted Kennedy, who died just here a few years ago. And they require, the Securities and Exchange Commission requires businesses who sell stock, or who, a better way to say it, who trade securities publicly, to do what is next, and that's to publish a prospectus. And a prospectus tells the prospective investor what he or she can expect. So the company who wants to sell the stock has to publish a prospectus for any potential investor before any new stock is issued. Now, you will also find that many companies will issue or reissue a prospectus when funds change or things like that, funds being in a mutual fund side of the house, or when other things change. One thing to tell you is to read a prospectus if you're interested either today or sometime in the future of investing in the stock market or investing in securities, better way to put that. Read the prospectus, but understand that the prospectus is no guarantee of future returns. Many times the prospectus will tell you what a stock has done, what the projection of the stock is, but that's not a guarantee. And the other thing that you have to remember, and I think it will come up here as we go through the slides, but if it doesn't, I want to point it to you now. There is no stock that's guaranteed by the federal government. Stocks are not guaranteed, returns are not guaranteed, dividends are not guaranteed, et cetera, et cetera, et cetera. So you put money in the stock, put $100 in, buy a share of stock, and it goes down to $50. That's what it's going to be. If you keep it for 10 or 15 or 20 years and it doesn't go over 50, you decide to sell, that's what you're going to get out of it, and you're going to lose 50 bucks. So chances are of it staying 50 for 10 or 20 years are pretty minimal, but that is a possibility. So stock goes up, stock goes down, and you do not get into, not just it's a cautionary thing that I mentioned to everybody every time I teach this class, and we're here at this particular point. You never get into the stock market to make money overnight. It just doesn't happen. Yes, if you're large enough, you have enough wealth, I should say, and you can buy enormous amounts of stock, and a penny or two difference or 3 or 4 cents difference makes a big difference to you. Yeah, but most of us aren't in that situation where a penny or two is going to make a fortune for us. So you don't get into the stock market for short-term advantage. That's not to say it doesn't happen. It could, but by and large, you get into the stock market for the long term. Now we're going to learn here a little bit about stock language, learning the language of stocks, if you will. Stock is a share of ownership. You buy a share of stock in Procter & Gamble or Coca-Cola or Kroger or AT&T or General Electric, any one of those large corporations, you are a owner. Now, of course, you're a higher owner or a lower owner on the totem pole, if you will, depending upon the number of shares that you own. So you have to take that into perspective, because one share allows you to be owner, and you will get a chance to vote, which we'll talk about a little bit later. The next thing is something you do not see too often, and that's a stock certificate. Years ago, when you bought stock from a company or you went through a brokerage house to sell it, you would get a certificate that said you were the owner of, let's say, 50 shares of stock. For the most part, those doesn't happen anymore. Companies don't issue that. They will have a transaction that says you that you own 50 shares or 100 shares, or what it happens to be. Maybe the company that you bought it through, the brokerage house you bought it through, will have that too. Will not issue that. One of the reasons that they don't issue that any longer is because that's negotiable. Now, what I mean by negotiable is, if you hold a stock certificate in your hand, you can go to a registered broker, a registered stock dealer, usually the same type person, and say, I want to sell this stock. Now, of course, the broker could say, all right, I want you to prove you're Sam Jones or Sally Smith, etc., and won't sell it until you can make that proof. But it is negotiable. So you don't see those too much any longer. I had an incident, I don't mind mentioning, that a relative of mine owns a large amount of stock in a well-known company in the United States. And she had all these stock certificates. And she's elderly, and she gave up the place where she was living, and had to move into a kind of assisted living, not, in a way. And so my wife and a few people went over and helped clean her place out and everything else. Well, anyway, long story short, while we brought all this stuff over and put it on our back porch, and came to find out after about 3 or 4 weeks of it being out there, we had a number of stock certificates that were worth a good amount of money. We didn't know that what was there. So that's another reason they don't like to do that. A dividend is what the company pays if it's made a certain amount of money, and they'll distribute that to stockholders. Remember that companies are not required to pay dividends ever. Ever and ever. Some companies pay dividends, some companies don't. Even though the stock goes up, they don't pay dividends. Now, it just already went up and took part of what I already said here about not having to pay dividends. It's a good way for a company to raise money because the shareholders don't have a say in management. Do not have a say in management, and they don't ever have to be repaid their initial investment. Plus the dividends, and bottom line here, because you're selling the stock, it's going to improve the company's balance sheet. Now, a downside to that, I said they're not involved with company management. That is true, not on a day-to-day basis. But if you have a large stockholder or stockholders, they can create trouble for a company during the annual voting, and many of them do. Well, pardon me, we're not getting enough dividend. The stock price is too low, and so they can do some foment with the other stockholders to make some changes. But they don't have a say in day-to-day management, and that's the point I want to make. They may eventually be able to exercise some leverage on management, but usually not on a day-to-day basis. What's the disadvantage? Well, stockholders have a right to vote. That's not necessarily a disadvantage, but it can become a disadvantage to management when stockholders get a little upset about what's going on, as I kind of prefaced this with some of the things about minority stockholders causing rocking the boat, if you will, or causing some problems. And so you have to be careful about that. When you issue more stock, that usually what means it's a diluted stock. You do that one of a couple of ways. You can do a 2-for-1 split. So what's a 2-for-1 split means? Okay, I own 100 shares, and they're worth $5 a piece, which means $500. And the company has a 2-for-1 split. I now own 1,000 shares, but my value is still $500. So the shares are now worth $2.50 a piece. They're not worth $5 a piece. So that can be done too. Remember, the dividends are paid in after-tax profits, and you can't take those off the balance sheet. They're not tax deductible. Two classes of stock, which we mentioned before: common and preferred. Common is the most often issued. These folks have the right to vote for board of directors and for other proposals offered by the company, and get paid a dividend if companies pay dividends. The preferred stockholder gets first dibs on dividends, and they can get those before any of it is distributed to the common stockholders. And notice here they can be callable, convertible, and cumulative. That does not, those same rights, if you will, are not deferred to or offered to common stockholders. It does not happen. The next type of security we're going to talk about is a bond. And I want you to keep in mind that the difference between a bond and a stock is, the major difference: a bond is debt. Selling stock becomes an asset because that money comes back to the company. Selling bonds is entirely different, or issuing bonds is entirely different. So what this says is, I have an IOU. Somebody lent me money, and I have to pay that money back. That's exactly what a bond is. It's pretty simple. It's about the simplest way I can explain it. So somebody lent me money, and I have agreed to take that money, and I have to pay that money back, normally with interest. So it's a $100 bond. That's the principal. That's the face of the bond. Of course, in the corporate world, we're talking about higher value than that. And then every bond has interest associated with it. And what that says is, I'm the bond issuer, and somebody gave me X number of dollars for my bond, and I have agreed, when I took on this debt, that I will pay interest to the bondholder at a specified time or time frame. So it could be quarterly, it could be semi-annual, it could be annual, but I have to pay that interest. Just think of this as if you have a mortgage on a house. You pay the principal and interest, and you're paying the interest because you borrowed money, and the money is issued to you at a certain rate. So that's what we're doing here. And we're thanking the bondholder for giving us the money, and a way of thanking them is to pay interest. Now, bonds have a great deal of advantages, a great number of advantages. Bondholders are owners of debt, creditors, but they don't hold voting rights, and they have no say in management. The interest that you pay is tax deductible, different from the dividend that you pay on stock. bonds are only temporary. And once the bond is paid off, it's gone. Of course, you can issue new ones, obviously, but once the bond is paid off, it's gone. And bonds can be repaid early if there's a callable provision in the bond. The biggest thing about issuing bonds is that you increase the company's debt. You borrowed money. We can't change this any other way. You borrowed money. That money has to be paid back. Think of this as buying a treasury bond or savings bond, not treasury, but savings bond. And I think you can buy a $100 bond for $50. And that's a debt that the U.S. government owes to you. And the U.S. government says, you give me $50 and in 30 years, I'll pay you $100. Now, that's not great interest, but it's good to have it safe. And so in 30 years, it used to be 10 years, but it's 30 years now that takes for maturity. So your money's working for you. You do accrue interest over that period of time. If in fact you decide you need the money before the 30 years, you'll get some of that, you'll get some of your original, you'll get your original investment back plus some interest. How much interest, it depends upon how long the bond has been held. Disadvantage is you have to pay the interest on the bond. There's no choice in that matter. It just depends upon how often you want to pay it. But there is no choice about it. I don't want to pay the interest. You have to pay it. If you don't pay the interest, then obviously people can take you to court. And the face value of the bond must be repaid in full at the time it's due. So if we took a bond out in 2004 and it was going to make it 10 years and it's due the 8th day of December 2014, the $1,000 bond, $1,000 has to be paid to me today, or I have to pay it to you today. However we want to look at that. I can't put that off. It's a debt. It's a legal debt. These are the bond ratings. I'm not going to go through this. There are 3 bond rating agencies in the United States: Moody's, S&P, and Fitch. And this just gives you their highest ratings. Now, the bond rating companies came under a lot of fire during the financial crisis, or actually after the financial crisis, because they were rating some of these bonds and other securities at the highest possible quality when they probably weren't. So the bond rating agencies have gotten a lot of flack about what they did and how they did it. Unfortunately, the financial crisis is past. And so a lot of times when that happens, people tend to forget issues that came up at the time things went on. And so the bond rating agencies probably, pardon me, are not being held accountable today as they might have been 6 years ago. Now, when I say the financial crisis is past, I'm not saying, nor am I intimating, that some people are not still having issues, that some people are still underemployed, that some people are still not employed. What I'm saying, however, is the financial crisis is over by all accounts. There's still some pain, but by and large, the financial crisis is over. And that's why I'm saying that the bond rating agencies probably have not being called to task any longer. Couple of different types of bonds. Unsecured means that it's just what it says. Somebody is going to issue you a bond based upon your good name, but you're not putting up any collateral, which is what a secured bond is. Secured bond is backed by some kind of tangible property, land, a building, maybe an automobile, something of that nature. Special features of bonds, the sinking fund. This is important to read to you. Reserve account set up to ensure that enough money will be available to repay bondholders on the maturity date. That's kind of an oxymoron in a way when you think of sinking fund. Sinking means something's going down. That's not what this is. It's to prevent that. Callable bonds, exactly what we said. You can pay off the face value of the bond before the maturity date, as long as that provision is embedded in the bond. And convertible bonds will allow people to convert the bond to stock. And notice it says common stock. If you're going to buy securities, you should go through a registered stockbroker. That person is a representative of a company that has a seat on a stock exchange. You want to be able to go through somebody who's registered to do that, and make sure that when you get, if you're going to do that, that person is registered. Has to see his or her credentials. There are online trading services. I've mentioned about this before. They do offer the ability to buy and sell securities online. Be careful about doing this. It costs you to do that. And I don't know what the charge is. The charge is not great, but it does cost you to do that. Most people who are not in the securities market are not sophisticated enough to make those trades. Now, I'm not going to say that people can't be. My wife has a high school classmate who does that. He's retired now, but he was a financial analyst for many years, so he knows what he's doing. Most of us aren't that. We're not into that business, so it's not something you can just do off the top of your hat. Go to somebody who's registered, who's in the business. This is ethical, making ethical decisions. Again, I'll remind you these are not required, but I certainly encourage you to look at them and read them because it's helpful. These are the criteria that you have to think about and measure when you're going to buy any security. Every investment has a risk. And so you have to determine what the risk is, high, low, medium, and what your tolerance for risk is. Normally speaking, the younger you are, the higher tolerance for risk. And the older you get, the more you want to get a little bit more, less risk. You have to be concerned on what the return is on your investment. Put up $100, what kind of money are you going to get back over a certain period of time? How long you're going to have to hold the investment to get your return. If you buy a bond, it tells you. Stocks will give you some indication, but again, stocks are not guaranteed. A bond has a guarantee on it. A bond is a debt. Liquidity simply means how quickly can you turn the money in, the investment into cash. And then what are your tax consequences? So you have to know what it's going to cost you and pay tax if you make money, how much money you make. Now remember, there's a lot of complaint about this. Why do I have to pay tax on an investment? It's making you money. It's the same as you go into work every day, but it's doing it differently. So it's not separate. You can't say, oh well, I don't have to do that. But if you're interested in that, then you don't want to pay money, and you get into tax deferred things that you don't pay anything until you retire, when your tax bracket should be lower. And if you work for a nonprofit, you can get the 403B. If you don't work for a nonprofit, you get 401k. You can get into some IRAs where that money is not taxed until you retire. Find somebody that can give you some good advice about the type of investment that you're getting into. I can't, this just says what I just said. You can take a class, a lot of libraries around the country offer this type of class. And you just have to check and see when they're going to hold it. Some schools that have continuing education, I'm talking about colleges, some high schools do as well, offer these type of classes. Annual average return on assets since 1926. I'm not going to go through this. It's kind of a gee whiz slide, so kind of look at it and it's something to understand. And okay, I'm not going to speak to everything on this slide, but I am going to tell you that this is the key to any investment, and that's diversification. Do not put all your investments in one category. Well, that's one of the dangers that a lot of employees make when they get into a company's 401k. Too often the 401k is heavily loaded with the company stock, and that's all well and good as long as the company stock is going to increase. But every stock is going to take a hit sooner or later. So you need to do whatever you can to diversify that. And you're not obligated, by the way, to buy just company stock. You can say to the company, okay, I don't want everything in XYZ Corporation stock. I want some of it split out. And they have to be able to do that for you. If it can't, then you might want to look someplace else. So just diversify. However you diversify is up to you, but diversify so you don't have everything in one place. This talks about this different types of investment opportunities. Again, I tell you, talk to somebody who's a registered broker who's been through a financial planning, is a certified financial planner, he or she is, give you some kind of idea of what to do and how. You can go to your bank. A lot of times the banks will help you with that as well. Primary investment services for consumers or the consumer's need. This talks to you here about a number of things, but you also need to think about tax planning and estate planning and things of that nature. None of us at our early age think we have to worry about taxes or estate planning. The unfortunate fact is those things creep up on you and you've not done anything about it. So try to do it now while you're young enough you can think about it, you can make decisions. The best thing to do is to start some type of a savings plan, no matter how small, and continue with it. Two types of investors. Bulls think the market's going to continue to go up. You know, we've been on a pretty good ride lately. The bears are just the reverse. They think that things are going to tank. And I suspect, and by the way, I don't have a crystal ball, I suspect we'll see some kind of correction next year. Although the economic forecast is good, I still think we'll see some type of correction because the stock market has been a pretty good trajectory upward for the last 3 or 4 years, and those things don't last forever. These are just talking about bear markets and what we've seen in a decline. Again, it's not something I want to talk about, but the most recent one we had, 2007 to 2009, the market capitalization of the Standard & Poor's lost almost 53%. And you notice that the Great Depression is not even listed on these bear markets. How do you want to select stocks? Well, you don't select stocks until you decide what your investment strategy is. Do you want dividend return? Do you want growth, as is mentioned down here? Do you want income? What is it you're looking for? And so you can answer that once you talk to a financial planner. Yes, it's going to cost you some money, but it's not going to cost you too much. Just to give you some kind of an idea. If you don't want to do that, then start your own savings plan, etc. I can recommend that you talk to mutual funds. It's an easy way to invest in the stock market without the same amount of pain. And you don't have to pick your stocks, but get some advice before you do that. Pay attention to Morningstar, which is the video that you're going to watch for Chapter 19. Give you some kind of an idea of things that you want to do. Give you some kind of an idea, because Morningstar does have things that you can go through for free and find out about the stock market. Stock splits, I talked about that a little bit before. Actually, what that is a company decides to split, and it doesn't change the ownership or anything else, but that becomes what's known as a diluted share, because the share is now no longer worth what it used to be worth. It is worth half that value. That's a 2-for-1 split. Some do 3-for-1. I've heard of an occasional 4-for-1, but not too often. 2-for-1 is the most common. Be careful about buying stock on the margin, because what that says is I'm going to put down a certain percent and buy that stock. But when the stockbroker calls the margin, you have to pay. You don't have a choice in that matter. That's like a contract. And so be careful about doing that. Avoid it. If it sounds like I'm preaching to you, it sounds like I'm giving you all kinds of financial advice, I am, to the best of my ability. Just avoid this. That's just like credit. And it's like buying on credit. It's like you're running up things on your credit card. Just avoid that. It's not a good thing to do. You can see this in your text. It'll give you an idea of of stock quotations. It's much better to look at in the text than it is on this particular slide. It just tells you what the current rate is. You can see this, by the way, at the bottom of page 537. And it gives you some pretty good idea of what the stock is. You can read local newspapers. Many local newspapers used to do the stocks all the time. They don't do that now. USA Today does a pretty good job of it. The Wall Street Journal, of course, does. The New York Times does. But every stock is not listed. Wall Street Journal probably does list every stock, but the New York Times doesn't list every stock anymore, and neither does the USA Today. They bring that down to a manageable amount. And of course, you can get financial news any number of ways. This just talks about them right here. You have to be careful about bonds. If you're a first-time bond buyer, you have to know what the worth of the bond is, what the rating has been given to it. You want to buy bonds that have stability. They're going to pay interest you don't have to worry about. You probably should avoid junk bonds if you can. It causes trouble. Yes, you can make a lot of money with junk bonds, but you can also lose a lot of money. And these are bond quotations, and you can see this on page 539 in figure 19.5. A mutual fund is set up by an organization that buys a lot of stocks and bonds, and then they try to get a lot of investors into that particular fund. So the risk is spread out over a wide number of people. And notice that money from the investors is pooled. My wife and I own a number of mutual funds, have been very successful with those. Well, I like to say we have been. I don't know. So far have been successful. That's another way to do it. It's a good way if you want to get in the securities market to get in a relatively small amount of money. Now, a lot of these mutual fund companies require fair down amount of money to buy into them, but it's better in the long term. But again, get a prospectus and find out the study and get some advice before you do that. Look out for the rating system. They talk about reform a rating system, information transparent. I again encourage you to pay attention to the Morningstar video because it will tell you a lot of what this slide has to say and some other things will really help you out. And Morningstar has some tools available for the average investor. Mutual funds has gone from 1980, where 5% of the households in the United States own mutual funds, to 2010, where almost half own mutual funds. Varieties of EFTs. This is the electronic funds. I'm not going to spend a lot of time on this because it's very similar to mutual funds. And you can see this, a quotation for mutual fund here. If you want to get into EFTs, talk to a financial advisor. This is how you compare investments. Gives you an idea of risk. You can see this, by the way, on page 541, figure 19.8. It talks about the type of investment, degree of risk, expected income, and then possible gross capital gain. Now, if you have a capital gain, you have to pay tax on that. And that's in a different tax bracket. So you have to find out what you want to do and how you want to do it. Get advice from somebody before you invest. And again, pay attention to the Morningstar video because it can direct you places that you can find. The Dow Jones Industrial Average is the one we hear all the time. It is not the most accurate because it's only based on 30 stocks. But it is the most often quoted because it's the easiest to calculate. The truest indication of the stock market, at least the New York stock market, New York Stock Exchange, is the Standard & Poor's 500 because it measures 500 stocks across a broad spectrum, not just industrial stocks. Market turmoil. We've been through this. October 29th, Black Monday. Variety magazine, Variety newspaper said Wall Street laid an egg. And look at what it lost, 13% of its value. But in October 1987, the market lost over 20% of its value. So it was worse than the Great Depression downturn, but it didn't last as long. That's the difference. There's the turmoil in 2007, 2008, 2002, and then 2008, what happened there. Wall Street, what it used to be, what it is today. Again, the gee whiz slide, which I'm not going to spend any time on. This is something that really influences the market. This first thing, program trading. These large traders like CalPERS that I mentioned before, they have program trades, and they're set up by computer. And they're programmed and said, if it reaches this sell or reaches this buy or whatever. And that really can kind of harm the market. A lot of people figure that's what happened in 87. There's supposed to be some safeguards set up to watch this, but they're not foolproof. Who's at fault for the economic crisis? I'll let you figure that one out yourself. I would say, obviously, categorically, without fear of contradiction, it was not Main Street. It was probably a combination of Wall Street and the watchdogs of Wall Street being a little too cozy, which happens fairly often, and people doing things that they shouldn't have been doing. And coming to many times what would happen, or at least I've heard stories, and you may have heard stories too, is that people would come to their bosses on Wall Street and say, okay, here's a different way to set up these securities and slice and dice them so we can make extra money. The problem happened to be that these folks that were doing this knew something about programs and things of that nature, and they thought they knew what they were talking about. Didn't always pay attention to the ethics. But what really happened was the bosses they were reporting to weren't smart enough to figure out what was being said. It was kind of a sham. And they didn't want to admit that they didn't know. So they went along with it. Now, that's a categorization, it's a generalization, not true across the board, but it happened too often. And the great financier Warren Buffett made a classic comment: beware of geeks bearing formulas, a twist on beware of Greeks bearing gifts. And people would come and show these magic formula or formulae. How can you lose? Well, because they weren't thought out and there wasn't a lot of grounding beneath them. So you have to be careful about those things. And then finally, this is cleaning up Wall Street. Unfortunately, I must tell you that businesses and financial institutions are fighting the Dodd-Frank bill tooth and nail. Too much of it has not been implemented. I do not think much of it will be implemented with the new Congress that was elected last month. I'm not going to disparage anybody, but the party that's coming into power is known to be unfriendly to regulation. And unfortunately, what happens in a yin and yang of type of economy we're in, we don't have enough regulation, and things happened in 2007 and exacerbated into 2008, 2009, and then we get more regulation and people rebel about it. Yes. So we need some kind of regulation. We have to keep it to where it does what it's supposed to do, and it's not onerous on businesses, while at the same time protecting people like us, the average investor. Well, we've at 5:28, I went on a little bit longer than normal, but this is an interesting chapter to me, and I hope it's interesting to you because it talks about how you can make money by investing. But again, please be cautious with what you do. So 5:28, almost 5:29. Let's take a break till 5:34. Please come back at 5:34. Thank you. All right, 5:34, we're back. We are now going to have our last chapter for which assignments are due, and that is Chapter 20, Money, Financial Institutions, and the Federal Reserve. Try to say something that and my mouth wouldn't get around it. And then next week, and I'll mention this again at the end of the lecture, we're going to have a little lecture on 3 of the bonus chapters, chapters A, C, and D. Chapter A, working within the legal environment. Chapter C, managing risks, and then Chapter D, managing personal finance. I think each of these will be interesting to you. There is no written assignment for that chapter, and we'll spend probably about an hour and a half next week doing that. And it is something I think that brings some of what we talked about throughout this course into greater perspective. At least that's my take on it. So now we're into, I think, something that's always interesting. We're going to talk a little bit here about money, and then hopefully remove some of the mumbo jumbo that sort of surrounds the Federal Reserve, although probably not enough. We're going to explain what money is. I mean, we all know, but we need to talk about what money is. Describe how the Federal Reserve controls the money supply. That's what's available to us, what we can get. You know, we don't go out and have the ability to get billions and billions and billions and billions of dollars. There's only so much that's available, and there's different categories of that money. Trace the history of banking and the Federal Reserve within the United States, not outside the United States. Look at the various institutions in the U.S. banking system, where they belong: banks, savings and loans, credit unions, etc. We're going to try to, in some cases, trace the lead up to the financial crisis that began in late 2007. It says 2008, but it actually started creeping up on us in 2007. The genesis was before that, by the way. But late 2007 is when it started to boil. And then, of course, 2008 is when it overflowed the pot. Describe how technology helps make banking more efficient. You know, banks want you to do all your banking online. They don't want you to come in and do too many more transactions these days. And then we're going to evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. There are a lot of countries out throughout the world that don't think too much about either the World Bank or the International Monetary Fund. And we'll talk a little bit about them. Nobody's going to be an expert when we finish doing that conversation. What's money? Now, you notice the slide says here, it's anything that is generally accepted as payment for goods and services. Generally accepted. Now, there are things that are not accepted. For instance, in the 1600s in Holland, now known as the Netherlands, people bought and sold things and counted their worth in tulip bulbs. And eventually that market crashed. So, you know, we have to have something that people recognize as money, that they accept. That's the key word. Well, I think recognize is part of it, but the key word is accept. So if we went back to that, came back, and people would accept that as money, we'd be back to it. But I don't think so, because the world has changed. There's a different issue here, and sometimes folks have a hard time understanding this concept. That's barter. That is trading goods and services for other goods and services. Or maybe I should say goods or services. And they don't have to be of equal value. But people always get something out of it. The one that I like to explain or use best as an example, when I taught this course in a face-to-face setting some years ago, we were talking about barter, and a lot of people were not getting barter right. And there was a woman there who was from New Zealand originally. And she said, well, I'll give you an example of barter. She said, I had some furniture I wanted to move. And I knew this fellow that owned a truck. And I told him, I said, if you can move that furniture for me, I'll cook you a chicken dinner. And so they struck a deal. He moved the furniture for her. She cooked him a chicken dinner. Now, the value was not equal. If we figure that he loaded the furniture and transported the furniture in his truck and then unloaded the furniture, we have to figure his time and effort and everything else and cost for the truck, wear and tear on the truck and gasoline and everything else. I don't have any idea what the cost was or how far it was going. She cooked him a chicken dinner. Now we can figure out, what the ingredients were and whatever she put in there. But most likely, he put more into it money-wise than he got out of it. I'm speaking money. And she put less in, but they each got something that they wanted with a barter. No money changed hands. So this is what has to, these are the 5 categories, if you will, or 5 characteristics that money has to have. It has to be easy to transport. It has to be easily calculated. Now they use the term divisible here, but calculated. We know that $1, well, there's a picture of Abe Lincoln here, that's a $5 bill. But we know $1, you could go to a bank and give them $1 and say, I would like change for this. I like the change that goes with this. I'd like 20 nickels or 10 dimes or 4 quarters or 2 half dollars, or I like 100 pennies. And the bank will give it to you, assuming everything's equal. Stability means it's going to last for a while. Now we know that metal coins, gold, silver, copper, whatever, last longer than paper, but paper lasts a while. You'd be surprised. And that stability, well, excuse me, stability means that it doesn't lose its value. I went the wrong way. Durability means how long it lasts. Stability means it doesn't lose its value, or a great deal of value over a period of time. And that it stands on its own. American currency looks a lot different than currency in Europe. European euros look a lot different than pounds issued in England. So we see these differences. And the United States currency operation and the Department of Treasury goes to great lengths to make the folding money, dollars, and the larger denominations unique and give them characteristics which make them difficult to counterfeit. Now we know there's counterfeiting going on, but they do their best to make them as counterfeit proof as possible. Now this is the money supply, and it's broken down into 3 categories: M1, M2, and M3. What I want you to think of in M1 is that's liquid. And it's money, as notice here, that we can put it in our hands very quickly, and we know the value of it. And we're talking about coins and paper and things of that nature. Also things like traveler's checks, because that's immediately negotiable for its face value. Now, yeah, you're going to run into some place that, well, we don't cash traveler's checks, or when you take American Express traveler's checks. That's irrelevant. What we're talking about is being able to, that particular criteria, or something if somebody's making a discriminator here. That's irrelevant, because that can be turned in some way, someplace, somehow, and you won't have to go across the world to do it in the rate of cash. Now, M2 builds on M1. So it's M1 plus, if you will, and it takes things in here like savings account, mutual funds, and things of that nature. And then M3 is M2 plus. So it builds upon M2 plus. And these are big, notice big deposits, money market funds, things of that nature from institutions. So M1 is probably what most of us deal with on a day-to-day basis. But we do have some M2, especially if we have money market accounts and savings accounts and mutual funds and things of that nature. This is how money is supplied and what we find money printed in billions in the United States. And then this next slide gives us an idea of how long a particular bill and denomination of United States currency lasts. And notice that a $1 bill, interestingly enough, lasts longer than either a 5 or a 10, but not as long as a 20. And then the other bills, the 50 and 100, last longer, most likely because they're not used as often. So that's the only reason I can attribute to that. These are money milestones. I don't want to spend a lot of time on this, but there is some interesting things here. 1956, the United States Congress established $1 as the minimum wage. Of course, we're higher than that today, but not appreciably when you look at inflation and things of that nature. By the way, I started working I want to try to relate something here, and I'm not able to relate it. I'm going to stop and continue on with something else. These are some money facts here. Again, this is a little bit of, as you know, I like to talk about gee whiz slides. What the United States printed, how much it cost for a penny. Most tracked bill, 2/3 of all $100 bills issued by the United States are not currently within the United States boundaries. And then 90% of all paper money has traces of cocaine. Now, this particular slide talks about paper money. I'm not sure it's talking about only United States money. I suspect it's talking about euros and pounds and a few other things. Now, this is what traders and governments do all the time, and that's exchange money globally in the global market. So if we have a dollar, by the way, I'm going to just jump ahead of this. Right now, the United States dollar is very strong. It's strong for a number of reasons. One is due to falling oil prices, and that the United States has a fairly good reserve of petroleum, and it is now becoming, or close to becoming, the #1 oil producer or petroleum producer, by the way to say that, and natural gas producer in the world due to some of the new extraction techniques, most common one known as hydraulic fracturing. So if the dollar is rising, which it is, we will find that foreign goods that come into this country are less expensive. Conversely, people who live in foreign countries will find American goods and services more expensive because of the rising dollar. The falling dollar is just the reverse, and we don't need to go into that. And we find that the dollar rises and falls mostly based upon two things. #1, the current geopolitical situation, and ours, especially economically, happens to be very strong at the present moment, and money speculators. money traders and speculators. Now, I'm talking about money traders, not government. They're not governments trading money with each other, etc. These are people who work outside the government. And so somebody will make a bet that the dollar is going to depreciate in value against other world currencies, and he or she will want to hold more dollars, and just the reverse when it falls. And so they do a lot of that. And for instance, my first experience with the euro was, I think, in 2000. And my wife and I were in Ireland, and the euro was 95 cents. In other words, it took you, if you wanted to even trade a dollar for a euro, you only got 95 cents worth. And of course, now the euro is about $1.23 or $1.24 to the dollar, which means that if you give them a dollar for a euro, you're going to owe them 24 more cents, roughly. So why that's appreciated, I don't know. The pound has been $1.50, $1.60 level for some period of time. But people want to trade in certain types of currency, so they make a currency more valuable than the other currency. However, the dollar is still the currency of the world, and it is what's considered a currency of the world. Things are based in dollars. For instance, oil today, what it is today, I don't know, but oil recently has been selling at around $66 a barrel. Now, that's the price that for Russian oil, for Saudi Arabian oil, for Iraqi oil, for Venezuelan oil, or any other type of oil. It's not in a rial, which is, I believe, Saudi may be something different. Rial is Iran. I don't want to go there. But it's not in the ruble, which is the Russian currency. It's not in the pesos, which I believe is the Venezuelan currency. It's denominated in dollars. This is what the impact of the falling dollar is. We get a favorable exchange rate. Companies, because they can sell their products more inexpensively overseas. And of course, that means more money, more profit coming in. If you travel overseas, then it's going to cost you more money. The flip side of that is that more European and other tourists will come to the United States because it's less expensive for them to do that, and more money will come to the United States. For instance, a lot of Japanese like to go to Hawaii, and so if the dollar is falling, many more of them will come to the United States, specifically to Hawaii than to other places. Now we are going from money itself into the outfit that controls money, known as the Federal Reserve. As you know, the Federal Reserve sets the interest rates. It sets a lot of other things, and it's made up about what we have here. There's a board of governors. The Federal Open Market Committee. There are 12 Federal Reserve banks. By the way, that listing is, I'll show it to you. We have a slide here, and then you can see the slide on page 558 in the text. 3 advisory councils, and then the member banks of the system. These are the 12 Federal Reserve districts. The most important of these, of the 12, is the New York district. And that's by tradition, it's by a number of other things. If there's a, what I want to say, this primacy among equals, it is primacy. It is first among the other 11 equals. This is how the Federal Reserve manages the money supply. Has the reserve requirement, open market operations, and then the discount rate. The reserve requirement is the amount of money a member bank is required to keep on hand. And it's like, you want to say this is like a buffer. So notice it says a percentage. Now the percentage has been 10%. There's been some talk, and I don't know where it is today, that the Federal Reserve wants to raise the reserve requirement. I don't remember to what level. I've heard 20%, but I'm not sure that's accurate. So they have to keep these on hand, this amount of money on hand, are noticed in non-interest bearing accounts with the Federal Reserve. So it either has to be at that banking establishment or banking institution, if you want to use that term, or it has to be with the Federal Reserve. But they're not going, Federal Reserve is not going to pay them money on it. They're just holding it for them. The open market operations is the buying and selling of United States currencies, United States securities, the bonds. We've had this program going on for some time known as quantitative easing, QE. I'm not going to try to explain it. I don't know that I understand it completely, but what the Fed has been doing has been buying bonds. They've been U.S. bonds, and they've been buying them at a huge amount of money for quite some time. Now they're going to slow that down, and we'll see what happens to the markets once that happens. It seems to me the Fed has started slowing down, but it's not gotten to an acceleration point. And that's what we're going to have to watch to see where they go. The open money, and then the discount rate, that's what the Fed charges to member banks for overnight borrowing. This is the check clearing process through the Federal Reserve. You can see this graphically displayed a little bit better than we have here but I am going to talk you through this on page 560, figure 20.3 in the text. And notice you have a buyer here in Quince Orchard, Illinois. I'm not sure exactly where that is, but I would suggest it's probably somewhere around Chicago. And the seller is a tractor dealer in Austin, Texas. It goes through, notice where it goes through. It goes through a local bank in Austin, which makes sense. Then it goes to the Federal Reserve headquartered in Dallas for that particular district, and that is District 11. Then it goes to the Federal Reserve Bank in Richmond, and I'm not sure why it goes there. Then it goes back to the local bank in Quince Orchard. So there are 6 steps. Notice here, well, there are eight steps. Notice here, 4 and 8 go back and forth between the Federal Reserve Bank and Dallas and Richmond. Now, Richmond may be the check clearing point, and then local bank in Quince Orchard 5 and 7, etc., and some other steps that you notice here. One of the things, however, that is very important to say to you is that the Federal Reserve has closed a number of check clearing facilities that had operated in the United States because of online banking. People pay their bills online, and so checks don't have to be manually cleared or even machine cleared today. My wife does virtually all of our banking, and she does it all online. Now, there's a couple of bills we don't pay online for a couple of purposes. One, we had something to do with the water or sewage, and they claimed that they didn't get the checks on time, and even though the bank said that they'd been paid, so we stopped doing that. We mail, but 99% of our banking is done online. So maybe it's not that, maybe it's 95%, but a great percentage. So the Federal Reserve has closed some of those facilities, pardon me, because they don't need them any longer. They don't need the personnel. The Federal Reserve was established in 1907, due to the stock market crash, or the actual financial crisis and crash of that year, 1907. Many people believe that that financial collapse was engineered by J.P. Morgan, a great financier of those days, and he had a good deal of the financial market. Whether that's true or not, I don't know, but J.P. Morgan also offered to put up enough money to get the to cover the needs of the recovery. And once he did that, the financial system seemed to get back in shape. But there was an awful lot of decentralization in those days. The Federal Reserve came into being at that time, and then in 1913, all federally chartered banks became or had to join the Federal Reserve System. Now, it's important to mention this because this talks about federally chartered by the United States government. If it's state chartered, it doesn't have to belong. I was assigned to a school. I was a student when I was in the Army back in the 1980s in El Paso, Texas. And I thought it would be a good idea for me to establish a bank account. The people at the school mentioned that. I wasn't too concerned about it. My wife wasn't with me, but I wasn't too concerned about that. So I did. I established a bank account. But the only place that I could do business with that bank was at that branch. It was a state chartered branch, a state chartered bank. It was not federally chartered. So if I wanted to write a check and I was across town someplace and I went to that bank, I couldn't do business with that same bank, a different branch of that same bank. Whereas it's not true if you're with a federally chartered bank. You can go to any one of the branches and have no problem. So, and then of course that could have been Texas law. I didn't know that. I didn't have to use the bank. It wasn't a big deal for me, but it was something that you needed to pay attention to, and so you always want to find those things out. This just talks about the largest bank failures we've seen. Some of them fairly recent. IndyMac in 2008. I had a student in one of my economics classes that talked about that because she and her husband a lot of angst. Of course, Washington Mutual Bank also in the same year, Colonial Bank a year later, and the cost and assets. Pardon me. U.S. banking system is made up of commercial banks. That's what most of us deal with. Savings and loans, credit unions, and then institutions or organizations or businesses that are called non-banks. And we'll talk about that shortly. A commercial bank is in business to make a profit. And it encourages people to come in and open savings accounts from which it will loan money and then will pay interest back to the holder of the savings accounts. Of course, they offer other types of savings instruments like money market certificates and money market accounts and certificates of deposit, etc. Two types of customers, and sometimes they're the same: depositors and borrowers. I'll give you an example. My wife and I hold a mortgage or own a mortgage, a house that has a mortgage, better way to say that, and we have an account with the bank that holds our mortgage. So we're both a borrower and a depositor. Now these are the types of services that commercial banks offer: demand deposit, time deposit, and a certificate of deposit. Now, a demand deposit, like a checking account, and the money's there, it's available, and you can go in and say, I want that money out, and you get it right away. A savings account is a little bit different. Bank can say to you, yeah, but before you take all this money out, we want you to tell us you want that money. And then a certificate deposit is a timed account. You put money in for a certain period of time, and that certain period of time, you earn X amount of interest, whatever that interest happens to be. Now, you can take that money out before that, just like we talked about bonds before. You take that money out ahead of time, but there's a penalty you pay on that, and the penalty is you don't get a certain amount of interest. Banking on social media, we talked about this before a little bit differently, and something you just need to find out about. But online banking doesn't get into social media. Social media is a little bit different, using smartphones, etc. I don't really know if I consider that social media. I guess it is because it falls in that definition, but it's not my definition of social media. Another, making ethical decision, what to tell the teller. Again, this is something that is totally up to you, but I recommend that you read these just to get through the thought process of going through decision making about what you do and what's considered an ethical dilemma or making an ethical decision. A savings and loan is something that is similar to a bank, but it's different. It has same things. I didn't always have a savings account. Didn't always have checking accounts. When I was growing up, I didn't know a savings and loan that had a checking account. You could get them to write checks for you, but was not a savings. It wasn't like a checking account. Of course, you had to have the money there for them to do that. And then home mortgage loans, and that's what savings loans were originally set up for. They were set up to promote savings and then to be a place for mortgages. And for many, many years, most mortgages in the United States, homeowner mortgages, were generated through savings and loans. Not as much today, but they were for years. Known as thrift institutions for many years, just for the reasons that I talked about: savings and home ownership. Credit unions are a lot different. Savings and loans and banks, commercial banks, are in the business to make money. A thought just went out of my mind. A credit union is is depositor owned, member owned. Better way to say that. Now, they can make a profit, but from what I know, that profit has to be returned to the owners in dividend, because notice it's a non-profit. And they also have exemptions from federal taxes. Now, they do many things just like banks and savings and loans do. Savings deposit, savings accounts, checking accounts, certificates of deposit, etc. They've gotten into more things than they were traditionally. That's not to be bad, but just they are. And then you have non-banks. Companies, businesses, organizations, institutions, whatever you want to say, that offer banking services but do not fall into the category of commercial bank, savings and loan, or credit union. And notice that companies around here, life insurance companies. A friend of mine, I probably mentioned him to you before, was a State Farm agent for many years. He just retired, and he got into this business. Not that he necessarily wanted to get into the business, but State Farm got into the business, so he was into those things. And they offer all these things that are mentioned here. Well, excuse me, don't offer things that are mentioned there, but they got into things like that, having brokerage accounts and corporate, having financial services and things of that nature. But these other companies get into that. Walmart was trying to do that. I don't know how successful they were. a lot of opposition to that, and I can't give you an answer. I'm not sure where Walmart either is or was with that. Non-banks that talk about this Mango store, bank-like facility in Austin, company that pay a one-time fee, as you can see here on the slide, and then they cash as many checks as they want by putting money on debit cards, etc. I don't know of any of those in the area where I am, the greater Cincinnati area. There may be in other places, and if you know about them, I wish you would share your experiences, not just with me, but with your fellow classmates. Notice what it says here, what attracts customers to online banking: free identity theft protection. Huge issue today. Identity theft is getting more and more and more. I mean, and we don't know why this is occurring. Sony was hacked pretty badly, from what I understand. Of course, that was probably industrial espionage, but regardless, we have people who hack for various and sundry reasons. Many of them don't think they're, don't think they're causing any harm. They get into this business and they just do it and do it and do it. Unfortunately, it does cause harm. People's information is compromised, and it's not something that people like to either admit or have happen to them. So have to be concerned about that, and it's something that's going to be around for, I'm afraid, for some period of time. Now, your money is protected by several different organizations depending upon where you have it deposited. FDIC is the Federal Deposit Insurance Corporation. That's for commercial banks. Notice that it is insured up to $250,000. Savings and Loan Insurance Fund, SAIF, does the same thing for people who have funds in savings and loans. And then the National Credit Union Administration, again, same type thing that guarantees deposits up to $250,000. Electronic transfer of funds, something that certainly can be done. You have to be careful about what you're doing. Sometimes there's a charge involved with this. And of course, that way funds can be moved very quickly over a period of small amount of time. A debit card is exactly what it says it is. Once you use a debit card, when you use a debit card, your money is electronically deducted and sent to the organization that controls the debit card, and then that's paid to the company that you're doing business with at that particular time. Same as the function. It functions the same as a check. You just have to know that if you are going to use a debit card, that money comes out immediately. It's not like writing a check in a way. You write a check, you put a check in the mail. Let's use it this way. You write a check, you put a check in the mail, or even if you hand it to the cashier where you're doing business, it's going to take a couple days for that check, that physical check, to clear. That's not true with a debit card. That's instantaneous. So there is a difference. It does function the same as a check, but the amount of time it takes to clear is entirely different. So you have to keep that in your mind. It does function like a check, except how quickly the money clears. Smart card, combination of credit card, debit card, etc. Other types of transactions in other countries, a letter of credit simply means that the bank has promised to pay this amount of money. Notice the tagline: certain conditions prevail. Banker's acceptance, it's a promise a bank's going to pay something at a specified time. And then money exchange allows companies to go to a bank and exchange currencies that are used in a particular country, and they do that, and they can sometimes gain money by making those transactions. Two international lenders of note. One is the World Bank, the other is the International Monetary Fund. The World Bank lends money to developing countries. The object is to help them improve efficiency in their operations, etc., and hopefully to raise the standard of living. International Monetary Fund is a cooperative, if you will, helps stabilize the exchange of one national currency to another. So we don't have wild fluctuations in currency exchange. Now, I'm going to come back to that in a second. I want to go back to the World Bank. A lot of developing countries don't like the World Bank because they say that their standards or their requirements are too onerous and they have difficulty complying with it. I'm not going to get into that. I just know that that exists, but that friction exists. But some countries would be in trouble if they didn't have what is considered in some cases a lender of last resort. International Monetary Fund trying to stabilize money. It does that to some extent, but pretty much a lot of that fluctuation really depends on geopolitical activities, such as the oil business today. For instance, Russia's ruble, that's their currency, is in what I would call free fall. And against the dollar, it's around 53 or 54 to the dollar. I haven't looked. I didn't look at it today. I probably won't look at it for a while. But it was around that over the weekend when I looked at it in the New York Times. That means it would take approximately 54 rubles to buy $1, and so that's going to be a problem. And as long as we have a lot of countries, I mentioned it before, Russia, Iran, Saudi Arabia, some other nations in the Middle East, certainly Venezuela, there may be a couple more, that their economy is pretty much pegged to the dollar, excuse me, to a barrel of oil and how much it is, and that for them to make to balance their budgets or get somewhere near balancing their budgets, oil has to be selling for around $100 a barrel, and it's down in the 60s. That's going to cause them a lot of problems, and really not too much the International Monetary Fund can do about that. So it's one of those things that we see happening quite frequently, and while we think that there are things in place to stabilize, along comes something like the oil market, and it's just the bottom's dropped out for a lot of exporters. So it's interesting to see, and I don't know how long that dynamic will continue. And then finally, we do have some new issues. Well, they're not new. You know, this text is a couple of years old, but they're still festering. Debt crisis in the Eurozone, especially with countries like Portugal and Greece and Ireland, and to a lesser extent Italy, is still causing problems. Japan, notice it says here, is trying to recover from the earthquake, but Japan's economy has really been, pardon me, in the doldrums for well over a decade. So there are some things, some dynamics going on there. China economy was slowing down, but now since oil has dropped precipitously in price, that their economy may turn around a little bit. It's hard to say. One of the things you have to remember is that countries like India and China, and also Japan, but certainly India and China, they are net importers of energy, petroleum. China has a lot of coal over there, but how much it does with their industry, I don't know. But regardless of that, the prices have dropped significantly. China pegs its renminbi to the dollar, So it's in their benefit. So that may help revive their economy to some extent. India, I don't know as much about, but that's possibly true as well. So this is something that's playing out. By the way, there's another one in there, Nigeria, I've forgotten. Was a huge exporter of oil to the United States, and the United States has not bought a barrel of oil from Nigeria in about 6 months. And so that's another country, and I've forgotten about them, whose economy is based upon petroleum and is now in relatively bad shape. So these are things that the International Monetary Fund and the World Bank are continuing to be concerned about over a period of time, and issues that will continue to play out. We'll see them and what happens. Of course, oil is the price of oil is cyclic, and was down in the doldrums not too many years ago, and it went back up. Went up what $150, $160 a barrel there for a while. So we can expect that's going to go back up. I think the best thing to say is for all of us consumers to enjoy what's happening now, because it's not going to last forever. Well, I thank you for your attention. That brings us to the end of chapters 19 and 20. And again, next week we'll talk about the three of the four bonus chapters. I don't do the one on information technology. Bonus chapter A was the legal environment. Bonus chapter C, managing risk, which is always something to be concerned about. And then finally, bonus chapter D, managing personal finance. Now, I thank you for your attention for this last 2 academic hours that we spent. And I will have the lecture uploaded for you tomorrow, hopefully by about 9:30 tomorrow morning, and hopefully it'll also be on YouTube, and I'll send you that link. So thank you for your attention, and good night.